Well, from superannuation to one investment that almost every Australian super fund will own, and that is BHP. The world's biggest mining company this week reported a drop in underlying earnings of 32% to $6.5 billion. It also cut its dividend. It announced it will sell two key Queensland coal mines, Blackwater and Daunia, as part of its focus on key commodities that help feed the world, help the energy transition and build infrastructure. Well, this week I spoke with BHP Chief Executive Mike Henry, and his proposition that growth in China and India will counteract slowing demand in Western economies.
We've been saying for some time now that we expect growth to lift in China over the year ahead. Since we first started calling for that, we've seen the policy shifts on zero COVID, as well as more supportive policies being put in place for the property sector. We now see that coupled with the government's commitment to lifting growth, pulling through to some green shoots from the start of this calendar year. Improved mobility figures, more bank lending, improved property prices in some cities, and very importantly, improved business sentiment. So a combination of the policy shift, the green shoots that we're seeing, give us even greater confidence about the year ahead for Chinese growth. And it's coming just at the right time, given the expectations of a bit of a slowing of growth in the US and Europe as last year's anti-inflation policies and the energy crisis play through.
Yeah, that's true. But also, what about the iron ore price growth in China in particular? Will that be perhaps curbed by China's plan to centralise its buying of iron ore through the China Mineral Resource Group?
Look, there's always so many factors that come into what determines commodity prices, supply and demand. You know, I've spoken about the demand outlook that we see, and we believe that's going to be a bit more positive in the year ahead. But of course, just like BHP is doing, other major suppliers are chasing more reliable production and a bit of production growth. So where that washes out in the balance, hard to predict. But what I can say is we've very purposefully and in a quite a disciplined way set ourselves up to be able to win in all scenarios. So we've moved ourselves to being the lowest cost supplier of iron ore globally. We've actually extended that lead in the past half to now there's a gap of 12% between us and the next best. We've also improved the quality of our underlying product suite with the development of South Flank, which was deliberately chosen to allow us to lift the average iron content in our products and to increase the proportion of lump, which attracts a premium. So we're feeling like our iron ore business is fighting fit and really set up to be able to deliver good value to shareholders over the long term.
The Blackwater and Daunia metallurgical coal mines in Queensland in the Bowen Basin. You're going to put those up for sale, saying that they would not really meet the hurdles for BHP committing more capital to them in the future, and another owner might be prepared to commit that capital. Why is it that this competition for capital, that they would be two that would miss out?
Well, it's partly the fact that BHP is a global company with global choices, and I include in that other states in Australia here. So, you know, in the same breath, we've spoken about the efforts that we have underway to grow our iron ore business in WA, and that's to potentially 330 million tonnes per annum. We're looking at growing our nickel business, our copper business in South Australia, all because we have attractive projects or potentially attractive projects and governments that are welcoming of further investment with lower risk in those jurisdictions. So this is how within BHP, as we work our way through our capital allocation framework, I don't think it would be a surprise to anybody to know that we're going to chase highest returns for lowest risk. And that happens both here within Australia, but also overseas. And we've had a very deliberate effort underway to grow value in future-facing commodities. That includes copper, it includes nickel, and of course, potash. And so we're doing a lot to accelerate our opportunities to grow our nascent potash business. Jansen Stage 1 going well, studies being accelerated on Jansen Stage 2. We've accelerated studies around potential copper growth, both in Chile and in South Australia, keeping in mind that copper production was already up 12% year on year, and there's more growth coming in the coming years. And we'll be looking, as I said, to potentially grow our iron ore business and our nickel business in WA.
So is this about decarbonising BHP, or is it more than that? Is this really about also trying to make certain that you've got the right projects at the right time? Because you will have metallurgical coal projects beyond these two that you will sell.
You know, what are we seeking to do here? We're seeking to have a portfolio that is as leveraged as possible to the big mega themes playing out in the world around us. That's population growth, higher standards of living, and the energy transition. Now, it's pretty clear, I think, to everyone that copper, nickel, and potash have a key role to play in the energy transition, or in the case of potash, for more sustainable farming. What may be missed by some is that higher quality iron ores and the best qualities of coal for steelmaking also see upside through a faster decarbonizing world. And so we stated a few years ago that we wanted to consolidate our coal portfolio onto only the best of the best. Because as steelmakers seek to decarbonize over the medium term, one of the main levers that they have available to themselves to do so is more efficient blast furnace production. That requires higher quality inputs. And so what you see here with this divestment decision is a further consolidation of our portfolio onto only the best of the premium hard coking coals, because we see the upside for those coals in a decarbonizing world.
Okay, then take me to the Oz Minerals acquisition, because that goes to the energy transition you spoke about. So that is all about chasing copper and nickel, plus also pretty prospective exploration tenements that they have on top of this. Now, they have other things as well. They have gold production. You've got rid of gold production over a long period of time. How do you balance that sort of stuff out?
Well, so we, whilst we got rid of gold as a standalone business from BHP some time ago, we're actually, we produce a fair amount of gold out of Olympic Dam because it occurs jointly with the copper. And that's the case for Oz Minerals as well. So if the transaction is successfully concluded and everything's on track in that direction currently, then we will not only increase our copper production, but would also increase gold production. And of course, it brings a prospective nickel project with it as well. I do want to say, though, that we only pursue transactions like this where the commodities are on strategy for us, where the assets are on strategy, and where we believe that we can unlock more value for BHP shareholders. And in this case, with Oz Minerals, there will be prospective synergies to be unlocked given the proximity of their assets to BHP's assets. Of course, they've got a great management team and a workforce, and so I've got no doubt that not only will BHP be able to bring some of its capabilities to bear on enhancing value in the current Oz assets, there will be lots of things for us to learn from the Oz team as well, which will help us enhance value across the rest of BHP.
Mike Henry, always great to chat to you. Many thanks for your time today.
Thank you.